Bring in Scott Kessler. He's Standard & Poor's head of technology equity research. Joins us now. Also, Sheila is joining me because she's been working on all things technology. Scott, let me just read back to you something that you had predicted, right before 2011. You said your predictions in 2011 that companies like LinkedIn are in no rush to become publicly traded entities. In our view, we don't expect any of them to file S1s, basically filing for public offerings in 2011. That's not the case. What happened?
Yeah, I was wrong, and the year is less than a month in. It's really interesting when you consider the fact that in our predictions for, I think, 2010 and 2009, we made predictions basically thinking, hey, these companies were going to start coming public, and that didn't happen. So perhaps we were just resigned to the fact that these companies were going to, as Jim Breyer indicated, push off coming public for as long as possible. But candidly, I think the market environment is...
But Scott, why didn't you think they were going to go public in 2011? Why did you not think?
Our view really was that these companies, whether we agreed with the notion or not, were kind of resigned to pushing off public offerings as long as they could. And it was our belief at the time that they didn't need to come public. And if they didn't need to come public, they wouldn't. So then
this might tell you that LinkedIn needs cash, or what? What does it tell you?
No, I think what we're seeing here, I mean, look, if you look at the S1, it indicates they have $90 million essentially on their balance sheet right now, and it's a profitable company. So we don't necessarily think that they need the money. The viewpoint on this is essentially that I think LinkedIn sees an opportunity. And frankly, the market is very conducive right now, we think, to technology and internet IPOs. If you consider what's gone on over the last couple of months, we've seen 2 Chinese IPOs in the internet segment coming public late last year and doing very well. Right. Then we also saw Demand Media, for example, coming public this week. Yeah. That fared well. It seems like there has been a lot of M&A sopping up a lot of the supply for technology investors, and the demand is really there.
Well, Scott, I mean, Demand and Nielsen, I mean, those are both very kind of mature companies. Is part of LinkedIn's strategy to get ahead of all the other social media IPOs that we could be seeing? I mean, you know, everyone's talking about Facebook, Groupon, et cetera. Do they just want to get out of the gate first for any reason?
I think that there is a strategic benefit to doing that. Over the last 6 months, people have been talking about a whole host of companies, like you mentioned, Facebook, Groupon, Hulu, a whole host of companies potentially coming public, and that's obviously not even accounting for those that filed their paperwork in August, like Demand Media and Skype. We think it really has to do with the fact that this company, frankly, has been around longer than some of those other companies. It already is profitable. It has multiple revenue streams.
Right.
And I think they thought this is a way that we can kind of capture people's interest and imagination now.
Sounds like, you know, this whole strike while the iron is hot kind of thing. Scott, thank you. Appreciate it. Scott Kessler of Standard & Poor's.